All right, since I know we're in the way between you and lunch, instead of introductions, I'm actually going to ask a question of our panelists today, which is, what are you tokenizing and why is it better on the blockchain?
So I'm building infrastructure. How I would say we tokenize the world, but I would be amiss in. Can you still hear me, or do I need to repeat again? Okay. So I'm involved in several projects ranging from the ETF world, this is structured products, as well as looking into what we have done in the crypto land. So I would say that the industry is in flux, and we're trying to figure out the efficiency of the industry with asset tokenization and achieving transactional efficiency and pushing the markets to the new era.
Yeah, that's a big question. Thank you for making it easy. So, hi, I'm Patrick. I'm the founder and CEO of Surus. We are an asset management tokenization platform with an embedded trust bank. Our mission is to tokenize or make available any asset to anybody, anywhere, at any time, right? That's a big, ambitious goal, and it's a multidisciplinary goal that requires both legal, regulatory, compliance, and technical understanding, and that's the team that we've brought together to do it.
Hi, I'm Justin from Ondo. We are taking a pretty narrow approach, I would say. I think that the world is not ready for tokenizing everything, at least not yet. We are very focused on tokenizing things that have immediate use on-chain already. I'm very much a strong believer that you don't tokenize something until it actually has on-chain utility, because otherwise you're not really using the token, and then what's the point, really? We are the largest provider of tokenized treasuries. In particular, we have two different products. We're a little bit north of 600 billion in assets now. We are growing about 10+% month over month, but I still think it's super early stage for a lot of this real-world asset tokenization stuff. So I think us in particular as a startup, we have to be pacing ourselves and bring the right products to market at the right time. But I think that we found a little bit of a niche with tokenizing treasuries as a way of bringing real-world yield on-chain.
Hi, good afternoon, I guess now. It's afternoon. So my name is Cynthia Bessette, and I'm responsible for the digital asset management business at Fidelity. And what we're focused on in terms of our tokenization initiatives is really just looking at where, and a little bit of what Justin said, where there are use cases to move an asset on chain, either because we make it more tradable and available to our clients to be used in portfolios, or if there is on-chain utility, and by that we mean that for traditional investors to be able to, for example, use a tokenized money market fund, which is an initiative that there are many in the industry that are working towards. That is a more efficient way to be able to use money market funds as collateral and being able to better manage your balance sheets in how it is that you are providing margin on your positions. And so from that standpoint, we focus a lot on infrastructure and we focus on use cases as we evaluate tokenization.
So I'm Hilary Allen. I'm a lawyer. I'm not tokenizing anything, but I thought I might contribute to this conversation with just a couple of traps for the unwary that I think are coming in some legislation that was passed in the House that I think people have not appreciated. So there was, alongside FIT 21, there was an anti-CBDC bill, and however you feel about retail CBDCs, I think there is language in that legislation that would essentially prohibit the Federal Reserve from engaging any kind of wholesale CBDC. And if you want to tokenize retail deposits, you essentially need that kind of infrastructure to make it work. So that's something to bear in mind. The other trap for the unwary, I think, is FIT 21. There is a carve-out for investment contract assets that basically would move them out of the jurisdiction of the SEC. And while you would think from this conference that the SEC was a terrible, horrible, no good, very bad thing, they do some good investor protection regulation. And currently, 75% of Americans don't trust crypto assets. And if you create something where tokenizing securities allows those securities to move out of the jurisdiction of the SEC, you're potentially going to lose investor trust there, which could make the tokenization of standard securities more challenging.
I do think half of us on the panel are lawyers, at least, but which can be helpful or harmful in tokenization, depending on how risk adverse you are. But when we're thinking about the benefits of the blockchain, there's many. I'm biased, of course, but there's speed, there's cost, and there's the democratization of access. Which one of those three are most appealing to you, or is something else driving your interest in the blockchain for tokenization?
So I would say, and I would discern between lessons learned from the crypto world. This is, inception of Bitcoin and the entire sort of revolution that transpired. I discern between transmission mechanism and asset classes. So for example, this debate we're having between the crypto native assets, which is again, the world that we all come from, and as we begin to tokenize existing assets, what are we trying to do with this? Because I think markets are quite efficient. We're doing, I agree, with Justin, we aren't tokenizing the whole world yet because we need to understand the efficiency of what we're trying to achieve with different asset classes. Where is the nuances of the inefficiencies in that, whether it's capital structuring or whether it's movement of capital or movement of collateral that underlies the asset. So to me, I discern between transmission mechanism, which I think DLT, blockchain, or various technology sets are amazing coordination technologies, and we have to mature them to a point that transmission becomes seamless and efficient, and that leads to other downstream effect of using tech to make the markets cheaper, faster, better, all three of them. And eventually, the access, which is the democratization part that you mentioned, becomes relevant because suddenly now we have more visibility, more transparency, and I see that as a primary transmission and coordination tech, because today we have a fragmented ecosystem, and we spend an enormous amount of time in using this batch relay system as to how we move assets today. That can improve, and once that improves, I think the system as a whole gets better. So I'll pause here. I'd love to get your opinion as well.
Yeah, so I agree that there's like a distinction to be made between sort of the market infrastructure and the technology behind that, and then sort of the legal structuring and like the regulatory aspects of this too. If you want to actually tokenize an asset, often it is a security in the US. I mean, maybe there'll be a carve out, but probably the way we're treating it is that most of the things that we're doing are going to be securities out there, whether they're on public chains or not. And we need to build out the infrastructure to allow that to happen in a compliant way, right? So that whether it's primary issuance or secondary trading, that there is some compliance mechanism baked in there that makes that work, and then extending that out, whether it's through digital identity or other things, so that you can bring up the scale from like state level to country level to global scale. That's infrastructure that needs to be built. The technology infrastructure is pretty far along, I think, on that side. I think there is a gap right now, mostly on the regulatory and legal and sort of the business infrastructure.
Yeah, I like right now, like it's not faster, it's slower, right? Like blockchains aren't that fast. I mean, they're very early stages, early tech, et cetera. They're getting a lot better. Certainly, Solana is a great example of making things faster. They're not cheaper. They're actually much more expensive. It's new technology. People need to learn all these different things. You're importing a new technology into any kind of regulated financial institution. That's just extremely expensive. And so I think like the real future promise is much more theoretical than practical at this point. And like you have to sort of say like, okay, like what's not so great about the traditional financial infrastructure that blockchain and tokens really improve? And I think one of the main things is really that you have all these different rails in these different countries for different types of assets, and none of them really talk to each other. And so blockchain sort of holds this very broad, partially theoretical promise of having all the assets sort of live within the same ecosystem and then be able to be interoperable. And that's, of course, a technological dream and maybe like a regulatory nightmare, right? I'm definitely not a lawyer. I've worked with a lot of lawyers and I'm somewhat familiar with the law in this space, but it's very much a bunch of technologists sort of rethinking financial infrastructure from ground zero, and sometimes they don't even have the legal regulatory expertise to properly do so, but are plotting forward anyway. So I think that there's a lot of very real possibility of the world's assets becoming tokenized and all living on blockchains, but I think there's a lot of important details that need to be worked out amongst both the technologists, the finance people, the regulators, and broadly all of that discussion still needs to continue to move forward.
So Cynthia and Hilary, do you think we will see a financial everything store? like Justin is describing?
So maybe I'll take this from the lens of an asset manager, and I said a little bit of this, earlier. The way that we think about what our responsibility is to our investors and to our shareholders of our funds is to provide an investment experience that is consistent with what it is that we've sought to do in that particular product. And if there is a particular objective where getting access to an asset has been difficult or more expensive, and this technology allows us to be able to incorporate that asset into a portfolio, those would be the objectives that drive what we're trying to seek. So we're not really necessarily focused on just faster or just cheaper, but really what we're focused on is a holistic investment experience that meets with what the client's financial needs are, and how it is that we've thought about differentiating what we can provide in the way of an investment experience. This technology can help us to be able to provide that differentiation, whether it's because we can now incorporate assets into a portfolio that traditionally have been difficult to trade or otherwise be included. That's the benefit of this technology. And so, what we see is traditional back offices now are evolving to be able to take into account how to account for and how to custody and how to look at these assets and from a portfolio manager standpoint to be able to see them on our dashboards with risk analytics as well. And so building all of that infrastructure takes time and takes a lot of resources to be able to build that in the right and compliant way.
So when you say financial everything store, I think single point of failure in the financial stability.
Yeah, I didn't say that, just for the record.
But no, I want to pick up on a point Justin made, which I think is an important one, which is in many ways our existing rails are not good. But why would we choose blockchain to rebuild them with, right? Aaron Klein started off yesterday saying, like, do you need blockchain for payments? No. Do you need blockchain for tokenization? You do not need a public permissionless blockchain for tokenization. You can run smart contracts, get the composability, programmability on any kind of ledger. And I think there's real concerns about using a blockchain. We heard a lot about the scalability challenges, about the cost, the expense. We haven't heard so much about the fact that the transparency is often a bug. People don't often want everybody to be able to see their trades in real time. We haven't talked about the fact that irreversibility is often a bug, right? Mistakes are made. People want to be able to undo a transaction without forking a whole ledger. But the thing that I think I find most sort of problematic about using the public permissionless blockchain for financial market infrastructure is that if you think about how we regulate financial market infrastructure, we have the principles for financial market infrastructure. There are all kinds of obligations for governance, accountability for maintenance, accountability for cybersecurity, requirements to plan for business continuity. If you are essentially relying on the Ethereum blockchain, as BlackRock is now with its product, there is no one who is accountable for those things. We are essentially YOLOing, Title VIII of the Dodd-Frank Act when it comes to this kind of infrastructure. I know that there are definitely there are open source communities looking at the code, et cetera, but that is not the same thing as having someone accountable. The buck stops to them to make sure that the infrastructure is maintained appropriately. And to my mind, that just makes the blockchain entirely unsuitable as financial market infrastructure.
Maybe I'll let the panel respond. What types of permissioning are you using either at the token level or the protocol layer on top of the public blockchain to the extent you're building on public blockchains?
So I'd like to respond to that at a technical level. A few things on this, right? One is blockchains aren't magic. When I was leading this at IBM and we went down the technical path to research the text, right? So blockchain has a few components. It has a database, it has cryptography, it has a bunch of consensus mechanism, which is how we coordinate as to how we commit something to database, which every bank does. So it's a combination of things that have evolved over 30 plus years. I think the branding is bad because blockchain is a bad term in many circles. I would say this though, that having built and having understood the technical landscape of how our financial systems connect. It's complicated. It's complicated in the sense that we finally got comfortable with cloud, we finally got comfortable with APIs, and I believe that the lion's share of energy that we spend, which is close to about $1 trillion, Oliver Wyman had this $1 trillion worth of global coordination between all these financial institutions, about $1 trillion, to manage $600 trillion worth of assets, which is the sum total of all the sort of bankable assets, so to speak. So I think what we're trying to address with blockchain is that coordination, and it's a evolutionary step where suddenly now, and I can have slew of things to adhere to BSA, adhere to AML, have a layer of technologies that can protect privacy. But the main thing we're trying to address is how do we seamlessly go towards the path that we are ready for the slew of all the conversations we have today with stablecoin, BaaS, is be ready for that digital infrastructure to facilitate seamless interaction between various financial participants that goes with it. So at a technical level, I would say that whatever you're doing now is sort of, if you were to take blockchain as a technical landscape and break it up, you're using all that tech anyway. We're trying to make that coordination process more efficient, and in that process, you make markets more efficient, make more transparent. So I would say that. And second thing I would say is, I also agree to the point that this lot happened overnight, which means you have an existing infrastructure, you have an evolving infrastructure, and we're not going to tokenize the whole world, but there is a whole new class of assets that simply are living in PDF files. You look at private markets and private equity, these are not exactly have any exposure. I think we can go after those inefficient and illiquid markets and try to bring them on. I think what Justin is building is, Ondo in general, is trying to give us a glimpse of what's possible to provide an efficient distribution. So I'll stop here, but that's my technical view on this, not a legal perspective, of course.
To me, I think it's just a difference in philosophy, right? So I don't need the internet to send you a message. I don't need the internet to book my hotel last night. I didn't need it to book my train up here. Like, there are other ways you could have architected that system where you had one person who is responsible for maintaining those communications networks, but that's not what we have. And you may think that the open internet is a bad thing, and that's okay, right? You might think that an open and accessible sort of financial market infrastructure where every participant has access, we say close to the iron, like right at that root level, is a bad thing. And that, publicly having like sort of a digital public commons that's supported through sort of these open source processes is a bad thing. And that's fine. That's like a philosophy. I don't share that philosophy. Like, I actually am the other way. I want to sort of empower individuals and give them more autonomy over their financial lives. And yes, that means that there's a trade-off from a risk perspective. I agree with that. And I also agree that there's a problem in terms of the privacy that happens on chain right now. There are like technologies that are being developed to help mitigate that, but they have to be done in a compliant way, which is a challenge. But so I just think it's a matter of like a philosophical distinction between like what kind of future you want to live in. Do you want one where you have to go through an intermediary, where you have to go to a bank to move your money around? Or do you want to live in one where you have like open competition for who could be that intermediary, or you could just directly send that money?
I mean, if I can just respond quickly, that sounds like a lovely world. I also want world peace. Right, but there is, there are economic incentives that tend to force intermediation. Whenever people are not willing to put in the time, the money, et cetera, to do their own work, they will gladly delegate it to someone else, and someone who will make a profit will come to that. And that is how we get intermediaries, and that is how the world tends to work. So as much as I love the vision that you have, I don't think it's a realistic one. And so if you accept that intermediation is inevitable, and intermediation is rife in every level of the crypto stack, from the validators to the concentration of governance tokens in DAOs, et cetera. So if you accept that intermediation is going to happen, then I don't understand why you put up with the inefficiencies. So to your point, I don't understand how it could be more efficient to decentralize than to have a centralized intermediary.
I mean, we're at the Fed, which is partially decentralized, right? Like, not everything in the world needs to be fully centralized. And even when the Fed was being created more than 100 years ago, there was a lot of give and take around how centralized should the central bank be. And there was a lot of back and forth and a lot of different concerns, and there's no right answer one way or another. Like perfectly centralized is obviously not great, and fully decentralized is not great either. And I don't think anybody up here is advocating for a world without intermediaries or a world without trusted parties that interact with these various different things. But really with blockchain, you're only really addressing a very fundamental part of the tech stack. Like it's not, I don't think it changes a lot of the actual financial products, frankly, or changes a lot of the market infrastructure. I think one of the main things that would be really helpful in the world of digital assets is more things like regulated clearinghouses that could come in and help people who are interacting using these technologies do so in a way that's somewhat, similar to how we do things currently. So I don't think it's an either or type of thing where you have to just totally get rid of the old system or totally get rid of the dollar. Like, no, I don't think anybody's advocating for that, right? I think it's an optional mechanism to be used, and I think there are tremendous potential efficiency gains from using these things. But
Why?
Sorry?
Why are there efficiency gains?
Well, I mean, I think that, for example, the thing I said before of multiple different rails for different types of assets in different countries, I think there's tremendous potential efficiency gains from actual on-chain protocols that operate autonomously and are battle-hardened. We're not putting $1 trillion into untested code. It takes time. It's going to take 5 years. It's going to take 10 years to get comfortable with these various different things. But many different institutions are exploring things like repo markets and other things that are relatively straightforward machinery that can be put into code that runs relatively autonomously. Some of these are public blockchains. Some of these are private DLTs that do have the ability to rewind, et cetera. And I think there's going to be somewhat of a different approach to risk for various different actors in the financial system. And I think that's fine. But I think to sort of unilaterally say that blockchain, which really is just like a fundamental technology.
I was only speaking to public permissionless blockchains. I think private DLT experimentation is a good idea.
So maybe one last thing.
Like I said, it's a philosophy difference.
My
right?
goal is to convince Hilary, and we all should be done by that whole thing. So if I were to break it down, and I've done this with execs to upsell as to what we're trying to do here is 3 I's, right? Infrastructure, which today is core banking, your CIC is your COBOL, all that manages, the tech that manages our financial infrastructure. In that, you can add some elements of DLT to asset tokenization, custody tech, which basically allows you to be able to have all these technical elements to make the bank function. The bigger challenge is the next I, which is instrument. So if I were to change, if I have the same token, for example, the same governance framework, the same regulatory framework, the same supervisory framework for an ETF, and I just change the modality of it for efficiency, and I change the infrastructure because I need to have a transmission mechanism, but everything else remains the same, the governance framework around it. And the fact that I'm increasing the velocity of these assets because things are more efficient, I'm using AI and advanced data technologies to be able to aid and help with supervision. Would that be a convincing argument?
I mean, I think generally speaking, I am of the same activity, same risk, same rule persuasion. So, if you're carrying out the same kind of functional activities, generally you want the same kind of regulatory construct. But there are new operational risks that come from delivering activities that we are familiar with in different ways. And my only point is, why would we take on the operational risks of a public permissionless blockchain when there are plenty of other ledgers that we can get all of the benefits that have been discussed?
And that to me is infrastructure. I haven't even discerned between public-private blockchain. And that debate ensues. I still think that we do business on internet, and we carve out what used to be back in the day internet, intranet, and now we have technologies like VPN to separate and concern those things. But I don't want to overtake your role here.
No, this is a great. My role is to just sit back and let you have a great conversation. But I think with public permissionless blockchains, there's clearly some semblance of product market fit, right? There's millions of people all over the world doing billions of dollars of transactions on public blockchains daily, right? And these people are opting into that. There's nobody forcing them to do that. They are choosing on their own volition to participate in this economy. I think, if you're looking at what use cases have, strong product market fit on public blockchains, I think one would be stable coins. And I'd be curious to hear on this panel how folks view stable coins, and then, money funds as potentially a next RWA that has some semblance of product market fit. What do you see the market doing in the future with respect to stablecoins and money funds on chain in particular?
So I would say I spent the last 8 years working on stablecoins, and now I'm a small business. I do my payroll using stablecoins, spend a small fraction, then I would go to traditional cross-border payments. I also, in my IBM era, worked on streamlining treasury functions of large financial institutions, especially when they work in Europe and US. And they have, the whole idea is if I can move liquidity with the speed of wire, can I move the liquidity where it needed the most without actually having to have locked capital in every country? So we're working on those innovative projects. And I would say that stablecoin, which I actually wrote a brief on this last week, the right product market fit, it's grown exponentially in the last 2 years. I think to me, it's a glimpse. It's a glimpse of the fact that it has a converse impact. The reason why stablecoins came into crypto is not everybody wanted to go into validating and mining, as you mentioned. It's an easy way to bring liquidity from your existing financial system to transact with crypto asset in that world. I think the industry will see a converse impact that when we begin to tokenize the use of stablecoin, and if eventually it enters the security settlement space, which is the large volume payments, you'll begin to see a massive growth in tokenization of real world assets, again, barring the private-public debate that if we tokenize these assets, the transmission becomes more efficient and hence transactionality. So I'm very bullish as I say.
I think that what we're going to see, well, obviously we're going to see a proliferation of stablecoins coming. We're already seeing the announcements rolling out. So it's just going to continue. There's just clear market demand, especially cross-border remittance and in those avenues. And it makes a lot of sense. If I can, if I'm in another country and I want to hold US dollars, it's a proxy for a US dollar. Where I think there's a challenge still, and what I would like to see with more competition in the stablecoin space, because I think there isn't enough competition in the stablecoin space right now, is improvement on structuring, right? How do we structure these payment objects so that they are safer for consumers and more transparent to consumers? Right now, we have a lot of issuers who hold their own treasury, and it's a little bit of a black box at the moment. And you don't know where you fall in the capital stack if if there's ever a problem and you're a creditor and things like that. One of the things that we're working on is creating bankruptcy remote trust vehicles that we can publish transparency reports on a daily basis to hold the treasury for the stablecoins that are backing it independent from the issuer by a regulated financial institution. I think that's the kind of improvement we need to see across all of the different sort of tokenization approaches, whether it's private chains, public chains, my Postgres database. It doesn't really matter where the object is stored.
Yeah, I can think of two things that we do currently that I think are pretty great examples of cool things that are happening on chain. One of which is you get instant redemption. So you get atomic settlement of you get cash back right away in the same actual atomic transaction when you bring the token back to us. This happens 24/7 with money that's actually already existing on chain. So that's just better than the status quo. Another example is that our tokens can morph with on-chain code from a form that is well suited to collateral versus a form that's well suited to payment. And the different types of forms are really just based on how you pay out the interest on your money. So one form, the value of the token increases over time. So if you stick that token somewhere and then you get those tokens back, they're worth more money later. This is extremely useful when you're using them as collateral in any kind of context. The other version is the tokens multiply in number. So if you've gotten 5% interest rate over the year, you've gotten 5% more tokens, and the tokens themselves are actually still worth $1. And so when you're sending somebody money, you want to send them $1,000, you send them 1,000 tokens. That's a very easy product for people to understand. But that's actually a very different structure of product that you want versus if you're using that token as collateral within an actual DeFi protocol. And there's no real mechanism for doing this before blockchain. And so, we're definitely not there. We're at a world where we have atomic DVP for all these different things, and that's nowhere near coming anytime soon. But I think it's something that is deliverable in a very interesting way, only really via the power of these public chains. I feel like this private DLT versus public blockchain argument is something I've been having for 10 years. And I think the market has spoken, to your point, and that these private DLTs, they are not blockchains. They don't really have any of the positives that a lot of the blockchains have. They don't have some of the negatives as well, but they also don't have a lot of the positives. But the actual really interesting stuff that's happening really comes from people who do believe in and rely upon, and this is a philosophical thing perhaps, but I do think it's something that more technologically savvy people are more comfortable with. Maybe that's right, maybe that's wrong, maybe it's a philosophy thing, but that there really is real product market fit, to Nick's point about what we're seeing in sort of public blockchain adoption.
So I'm going to take maybe a combination of a technical, but also more of a, again, speaking more from the asset manager's lens, a practical standpoint. And the whole idea of public versus private blockchains, our general view is that this is going to be a multi-chain world, not 1,000 or 5,000 chains, but there will be multiple chains that will have utility and will have purpose. Some will be public and some will be internal blockchains. And at the end of the day, right, what a blockchain is a database. It's a ledger, and it provides a standardization for how it is that we can track the movement of assets, the creation of assets, and the ownership of assets. That's really all it is. And so a public blockchain has value from the standpoint of providing a single standard in a transparent way, and we'll get to transparency in a moment because you're absolutely 100% right. And we see those same challenges today, from our trading and markets on how much transparency do we want to have in the way that institutions are trading, for example, just like an individual who's going to be transacting on the blockchain, how much transparency is going to be good from a market standpoint, is going to be good from a risk standpoint. And so there are different mechanisms that we've deployed over the years in order to protect investors' privacy while still participating in public markets. And so going back to public versus private, the ledger itself is just a mechanism by which people can track their transactions. The programmability of the individual tokens, and I think, Nick, you had highlighted this, is how it is that individual issuers or asset owners are going to be able to interact in a more automated way in the public space, but still be able to affect appropriate eligibility criteria, legal and local regulatory criteria. And that's really what the power of this technology for capital markets means in the future. From the stablecoin standpoint, it's critical market infrastructure. It's basically tokenizing cash and making the market interoperable and able to operate across holders of tokens, and to be able to trade a token against a stablecoin and being able to transact more effectively and more cheaply.
So, I mean, I think the question is a very valid one. Where is the product market fit for this public blockchain? And I do actually agree that it's kind of philosophical, because I think the reason why, well, it's not philosophical, it's money driven. The reason why, it is sometimes philosophical and sometimes money driven, let me be clear. But a lot of the appeal for public blockchains is that it is a great way to do regulatory arbitrage, right? It is a great way to convince regulators that there is something new going on here that cannot be regulated in a similar way, and that can be quite profitable. So now, what I mean about the philosophical aspect is some people are fine with that. They think we should have less regulation and let the chips fall where they may, and some people are more proactive about wanting to prevent harm and are more pro-regulation, and that's clearly the camp that I fall into. But what concerns me is the people who are of the more let the chips fall where they may variety. Will that really be the reaction when there's a problem? So you raised stablecoins. I will not go into the details on stablecoins. I was on the panel last year on this conference and made my views known. But I would say that I have noted, I think 5 times during this conference, I've heard mention of, we need the government to shore up trust in stablecoins through legislation. Now, to me, that is suggesting an implicit government guarantee or something like that. If you're going to have that, shouldn't you be regulated as a bank deposit or at least as a money market mutual fund? So I think the problem for me is that when things go south, the expectation will be for government support, even though it's sort of come out of a space of wanting less regulation.
So I imagine the panelists are not anti-regulation, and so maybe, and I think we're pretty close to time, I don't know, 2 minutes and everybody's hungry. So my last question would be, what is your favorite and or least favorite current or proposed regulation as it relates to the blockchain?
We'll start from there.
Least favorite, Fit 21.
Okay, I'll come back here, and then you can go back.
Or SEC lawsuit.
No, I'm not going to lawsuit there, but I think, so two things, right? One is any regulation that meaningfully looks at this industry, both of its technical merits and the pitfalls, as you describe it. I think it's a good effort and good. So any regulation that passes that gives some clarity, I'm good with that, right? And second thing is, I do want to discern between the technical areas that has advancement that has happened in the space for the last decade, and separate the application, which is the tokens that go with it. And last thing I would say is that clarity in stablecoin is less about technology. I think it's more about money supply. It's a central bank agenda in general. So I think I'll leave it at that. Those are the sort of three things for me.
Yeah, I'm not super knowledgeable about the things that haven't passed law yet, but I would say that the spirit of the laws around all of these things are actually relatively clear. Like, I don't think there's actually a lack of clarity around what money laundering is in a tokenized world. Like, I think it's exactly the same. It just happens to be a token, so I think, a lot of this does require some particular nuanced, detailed clarity for certain, implementation details. How do you deal with like new operational risks? All that stuff obviously needs to be ironed out. But generally speaking, I think like the spirit of where regulation was and how that interoperates with a tokenized blockchain world is actually not unclear to me at all. We make tokenized securities, we've issued them and done the things you'd expect. We have a KYC process, we do AML, we can see with abundant transparency, to your point, of like every time a token moves on chain, we can see it, right? I mean, it's arguably better, in my opinion, for regulated financial, at least in various different pieces, but the transparency has to be an amazing thing for doing audits in various different parts of things. So, in my mind, like the only point I really want to make is that the spirit of following these rules is really, in my opinion, not hard to follow.
That's right.
All right, last thoughts, Patrick and Cynthia.
I welcome the engagement, and having been in this space for several years now, the fact that there is a conference like this where there are policymakers and there are participants across the industry who are interested in how it is that we can work with this technology in a productive way, and we will have lawmakers and policymakers focused on how do we look at and how do we create more clarity for the industry to continue to embrace technology. That's a positive.
I have zero interest in regulatory arbitrage, to be clear, or any of that nonsense. We're chartering a financial institution. We embrace regulation. I think that more companies in the space need to actually open their arms up and embrace regulation. My good friend Gary, when he came up to MIT and I was at Harvard, he would come to my reading group and we would talk a lot about this stuff. And he used to have a philosophy. He said, when a new thing comes up, at first you ignore it because you don't want to give it credibility. Mm-hmm. Then you integrate it into the existing regulatory framework. And where there's a gap, then you regulate it with new regulation. I have to say, I'm a little disappointed in my friend Gary because I don't think he's been doing such a great job on the integration side of it. But we have exposed gaps in the ecosystem as we've tried to integrate these things. But there's still more work to be done on that integration side. As we find those gaps, I think it's absolutely correct to have legislation that steps in and fills those gaps and provides clarity and provides a mechanism for people to do things on both public and private chains and wherever the hell else they want to do it in a regulatory compliant way, embracing regulation and bringing innovation to the market.
All right. Thank you, Jalapa, and thank you to our panelists.
Thank you, Jalapa. Thank you.